This week, financial markets felt like walking a tightrope, swinging from panic to relief and back again. On Monday, fresh threats of tariffs against Europe, tied to the unresolved Greenland negotiations, triggered a sharp sell-off across equities and risk assets. But by midweek, the script flipped. At Davos, the U.S. president announced a tentative framework for future cooperation with NATO, lifting both tariff and military pressure. And with it, some of the market's anxiety. But let's be clear, a pause in tension is not the same as resolution. The visibility across major indices remains clouded. Even with a potential deal, the underlying geopolitical risk is sticky. And that's reflected in how traders are positioning. The S&P 500 closed slightly down at 6915, while the Dow slipped 0.53% tech. However, held up better. The Nasdaq 100 eked out a 0.3% gain. European markets like the FTSE 100 fell nearly 1%, showing how exposed they still are to tariff rhetoric. Commodities, meanwhile, surged, gold up 6.6%, oil nearly 4%, and the euro strengthening by 1.7%, all classic hedges against stability. Under the surface, the winners and losers tell their own story. Moderna and Albemarle surged over 16%, riding biotech optimism and lithium exposure, while Hecla Mining jumped nearly 20% on silver's breakout, which, by the way, is up 38% year to date. On the flip side, Abbott, Coinbase, and AeroVironment all dropped sharply. Abbott's miss in the nutrition segment hit hard. AeroVironment faced a temporary duod contract pause. But one interesting takeaway, even companies with strong earnings, like Intel last week, are being punished if their forward guidance doesn't match market expectations. This isn't a boo the dip moment. It's a believe the forward market. In commodities, gold is making serious moves. The price hit $4,982 per ounce, almost touching the psychological $5,000 mark. And it's not alone. Silver and platinum are both at record highs, driven by a weakening dollar and waning trust in U.S. fiscal policy. Goldman Sachs now sees gold hitting $5,400 before year end. That's no small target. Natural gas is also spiking. A brutal cold snap in the U.S. pushed heating demand through the roof, sending us and European gas prices up nearly 10%. And with European storage levels running low, this could keep pressure on energy-intensive sectors. On the agriculture side, grains are pushing higher again. Weak dollar, bullish, weather, uncertainty, even more so. Wheat futures rose to 520 cents as traders braced for crop stress. Meanwhile, cocoa prices are collapsing down to 2-year lows. That's a classic case of oversupply meeting demand fatigue. In macro news, U.S. GDP for Q3 was revised up to 4.4%, and Q4 is expected to print at 5.4%. Inflation, as measured by core PCE, dipped to 2.7%. Those are green lights for stocks on paper. But as always, it's not just the numbers, it's the narrative. And that brings us to crypto. Bitcoin dropped 4.4%, falling below $90,000 once again. Since November, it's been stuck between $85K and $95K. The price action says it all. No breakout, no breakdown, just indecision. This week's ETF flows confirmed that after $1.4 billion in inflows last week, we saw $1.2 billion in net outflows. Risk sentiment is fragile. Altcoins followed suit. ETH minus 11%, SOL minus 8%, XRP minus 4.6%. Without a clear catalyst, crypto is drifting. And in this kind of macro, drifting is dangerous. Now all eyes turn to next week's Fed meeting, with markets pricing in a 95% chance of no rate change. But the press conference, that's where the real volatility lives. And with Powell nearing the end of his term, his tone matters more than ever. In earnings, the stage is set. Microsoft, Meta, Apple, Visa, Tesla, LVMH, ASML, Sappi, some of the biggest names in tech and luxury will take the spotlight. Expect sector rotation. Expect surprises. As for now, step back, zoom out. This was a week where we saw a micro crash, a micro relief rally, and under it all, a market still unsure what narrative to believe. Enjoy the weekend. The real action starts again Monday. This week in currency markets, the US dollar is walking a tightrope, caught between two opposing forces, strong macroeconomic data on one side and rising political volatility on the other. Let's start with the fundamentals. On paper, the US economy is still delivering. Growth is solid. Productivity is ticking up. Inflation, after a brief spike from tariffs, is easing again, with CPI now sitting around 2.6 to 2.7%. Real incomes are positive, and consumer spending hasn't cracked. This is not a recession setup. Not yet. Labor markets, they're cooling but not collapsing. The jobs being added aren't strong enough to pull in new entrants, but there's still enough to support demand. And let's not forget, the wealth effect from stocks and real estate is keeping spending afloat, especially with boomers in the mix. On the monetary front, policy remains accommodative. Rate cuts are still on the table, just not immediately. QE has quietly crept back into the conversation, $50 billion in standard QE and another $200 billion in mortgage QE through FNMA and Freddie Mac. That's a lot of liquidity. And over the medium term, it typically weighs on the dollars. But here's the catch. That effect's not linear. It's also tied to political trust. And that's where the second fire comes in. We're entering a U.S. midterm election year, and markets know what that means. Erratic headlines, policy pivots, and pressure on the Fed. There's growing concern that the central bank's independence may be undermined or at least tested. And when that happens, capital starts looking for cover, gold, silver, other hard assets. Even foreign currencies begin to look safer. Still, don't count the dollar out just yet. In the near term, volatility, especially political, tends to favor the greenback. Think of it this way. When everything's unclear, cash is king. So even with the medium-term outlook weakening, the dollar could stage a bounce early in the year driven by risk aversion, not optimism. Let's talk levels. EURUSD is drifting lower, now eyeing 1.1550 and possibly 1.147. A break below 1.1470 would confirm a long-term trend reversal. Until then, this pair is just trading within a wide range, 1.147 to 1.192. Not trending, just drifting. This is where traders get chopped unless they wait for a clear breakout. USD JPY is a different story. The pair hit its short-term target at 158.88 and possibly 159.25. There are rumblings of a joint intervention from the Fed and the BOJ to cool down the yen. But let's be real. That's mostly jawboning for now. Until we see coordinated action, the dollar-yen pair remains supported, with resistance at 161.95. Technicals are overbought, yes, but momentum hasn't rolled over yet. US Dictet is flatlining below 1.394. Holding that level since late 2025. First support is 1.385. And a break below that would confirm the end of the recent rebound. Commodity-linked currencies like the Aussie and Kiwi continue to attract buyers, holding strong above 0.6600 and 0.573 respectively. With gold, silver, and energy prices rising, these currencies are getting tailwind support from the commodity complex. Now, a practical note from recent trades: in uncertain environments like this, baiting breakouts is a common mistake. Traders expect continuation, but the macro tone flips before the move confirms. One way to avoid this: treat price levels as zones, not lines. Don't chase. Wait for structure. Zooming out, what's the play here? We have a strong economy, weak politics, dovish central bank, and rising gold. That's not a crash setup. That's a rotation setup. Traders aren't panicking. They're repositioning. From dollar to metals, from tech to commodities, from certainty to hedges. So while the dollar may bounce in the short term, driven by fear, its longer-term story is already being written in silver, in gold, and in currencies quietly grinding higher under the radar. This is a currency market that's not broken, but it's searching for where the next real anchor will be.